Hi guys.
Hello. Just testing the sound now. Can you guys hear us?
Yeah, do let us know if you have any sound issues.
Yeah.
This for this session we have live chat. We have live chat on. So on the right of your screen you can see that there's a live chat. So if you want to say hi, say hi. If you have any questions about CPF for us, we'll do our best to answer it.
Okay, we're just going to wait for a couple minutes for people to join us.
Yeah. Do let us know if you can't hear us. Okay. So yeah, just give a shout out if you are clear, even if you are clear. Thank you.
Okay. And for those of you who have just joined us, we also have a sign-up offer for you for listening to our webinar tonight. So if you scan this QR code and set up your account today, you'll get 50% off your access fees for 1 year, provided you invest at least $10,000 of CPF.
Yeah, so do also subscribe to our YouTube channel. We have been running a few webinars. We have been running a few sessions of the webinar. Okay, so the webinar, there's like in total of four. This is our fourth session.
Yeah.
Yeah, this is our fourth session, and you can check out the other webinars that has been stored inside our YouTube channel.
Okay, so we're just gonna wait a couple more minutes to start.
Okay, so I think that there might be some audio issue, guys. I am just doing a bit of a sound check. So, is there any issue with that? Guys, let us know. I'm just gonna carry on talking for a bit, right? So, let us know, and we will be able to rectify it as soon as possible.
Okay,
Oh,
thank you.
okay.
Thank you guys so much for putting that on the live chat.
Yeah.
Okay.
Thank you, thank you. That's great. Yeah, because we had a little bit of a hiccup last week, so it's great to hear that everything is fine now.
Yeah.
So I guess with the COVID virus, maybe YouTube is pretty taxed in terms of their infrastructure.
Yeah.
Yeah. So
So maybe we can just do a quick introductions of ourselves. You
yeah,
want to
sure.
start, Shang-Chi?
Yeah, sure. So I'm Sheng Shi. I'm the personal finance lead of Endowus. I've been here since last November. Previously, I've worked in private equity real estate investments in an investment function. So previously we in CapitaLand, Capital. So very happy to join the Endowus team to make a difference in terms of CPF investing and SRS investing and cash.
I'm Sin Ting. I'm the Chief Client Officer at Endowus and one of the partners. So I started my career in private banking. I was in Morgan Stanley in Hong Kong, and then I moved to Singapore about 10 years ago. And my last job was at Nomura. One of the reasons why I left the private banking industry was because I felt that it was very transactional driven, and I felt like bankers were not always very aligned to their clients' interest. And that's a big part of why we started Endowus. We want to be a fee-only financial advisor, and we want to be completely aligned with our clients. And with that, maybe we can also first touch a little bit on what CPF means for the both of us, for Shang-Chi as a Singaporean and for myself as a PR.
Yeah, so what I always think about CPF is that CPF is there for us when for our big financial decisions, right? So when I was a child, my parents funded their first home using CPF, and now that I'm older, I see a lot of my friends who are at the stage of getting married and getting their own home. They consider using CPF for their housing, and for my grandparents, of course, they use CPF for their retirement, for their medical costs, etc. So for me, CPF is about big financial decisions and being guided by the government for the big financial decisions.
So I became a PR about 5 years ago now. And I'm so grateful to be part of the CPF system. I'm from Hong Kong originally, and we have what we call the MPF system. It's different from CPF in a couple of ways. Our contribution rates are a lot lower, for example. It's only 5% from the employee and 5% from the employer. And one of the other big differences is also the government does not give any guaranteed returns to your MPF. Unlike Singapore here, where you get 2.5% in your OA, 4% in your SA, which is actually incredible for basically risk-free returns. And I mean, I plan to be in Singapore for the long term, so CPF forms a big part of my retirement strategy. So it's really important for me to figure out how I can maximize my CPF as well. And with that, maybe I'll just kind of run through the structure of our presentation today. And as always, if you have any questions, please put it in the chat function on the right. We want to make this as interactive as possible. So I'm going to first touch a little bit about how much we're actually contributing into our CPF. And then Shengxi will talk about, even though CPF makes up such a big part of our net worth, why a lot of us tend to neglect it. I'm going to talk about, what can we actually use our CPF for, focusing on CPF OA and what the different options mean for you. And lastly, Shengxi will talk about what are the ways to maximize our CPF at our different stages of life. So, the total amount of CPF balances now is over 425 billion. When I first saw this statistic, I was amazed. There is an incredible amount of wealth in Singapore's CPF. And every month, you are actually contributing 20% of your paycheck to CPF, and your employer contributes 17%. So let's just look at some numbers. The median salary in Singapore is 4,500. And what this means is that your take-home salary is 3,600 per month. And you're actually contributing to CPF 19,980 per year. And most of us will be CPF millionaires by the time we can withdraw money at 55. So say you started off working at 25, you had a starting salary of $3,000 with 4% growth per year and 2 months of bonus. You'll actually contribute close to $800,000 in your CPF by the age of 55. But despite this, Singaporeans still have major financial issues ahead of us. OCBC did a survey last year, actually, where they found that almost 65% of people felt that they were not accumulating enough funds to maintain their lifestyle after retirement. So now I'm going to pass it to Shengxi, and he's going to talk a little bit about, despite CPF being such a big part of our net worth, why do we tend to neglect it?
Okay, yeah, so thank you, Sinting. So there's a few reasons why we neglect our CPF. I'll cover these points. So one of the first one is that we are conditioned to do so, right? So as someone that has started working for some time, I realized that when looking back, when I first received my first paycheck, the amount is already deducted for us, right? So whatever that we receive is a net pay. We don't really ever have our gross pay. So that is an issue, and we have to realize that CPF money is our money. So maybe let me just take a step back and elaborate more about some personal finance concepts, right? So there's this concept called pay yourself first. It's actually very helpful for people who are not so conscientious with saving their money, right? So the first thing that we have to do is to set a budget, and we have to be very strict with ourselves for that. Right, so if you're buying like spending $2,000 in clothes, spending $2,000 in food on a monthly basis, when you're not earning as a young fresh graduates, then you may want to set a budget. So what happens is that you should budget your food, rental, transport, parents' allowance, etc. in a very careful way, right? So you plan your expenses, and in this case, we're referring to an example of $2,500. right? Then the next step would be to determine how much savings you can get on a monthly basis. Meaning to say you take a gross salary, you net off your CPF contribution, you get what you get in your bank account, right? So after the bank, you calculate how much you're supposed to get in your bank account, you deduct away your planned expenses, and you have your planned savings. So what you need to do to help yourself be very conscientious with your saving is that you set up a high yield savings account. That's one thing. And another thing is to automatically transfer your planned savings to this account, right? Whatever you're left with is your budgeted spend. And then you should only keep within this budget, and so that you are able to have your planned savings. So in that sense, you are, through this process, you are managing your money, but you also are forcing yourself to save first before you spend. So the next thing will be to how CPF help us manage our money. So I guess I do a bit of the previous. I manage my money quite carefully, right? I do the pay yourself first thing. But I guess from the government perspective, they want to help people who are not very hardworking in terms of saving their money. Right, so what happens is that the government help us set a budget, right? They decide on the key blocks of good financial planning for Singaporeans, and then they get the employers and the employees to fund these key blocks. And of course, right, the money that we see in our bank account every month has already been net of CPF. So this money has been allocated to the different CPF accounts. It's automatically transferred for us, and we are only allowed to spend the remainder of our budget. Right, so I guess going back to how we neglect CPF, right, is that CPF monies, we never really control it at the start, right? So since we don't go through that process of managing it, we don't feel like it's our money. And then, the only time that we can really use it is only at 55. So I go to the next point, the strong association of CPF with housing. And yeah, basically, CPF OA money, the most tangible way that we can use it is through housing. So for many of us, housing is something that our first interaction with CPF, or first consideration of CPF, right? For many of my peers, when they first look to buying their first home, it's very expensive to buy a home in Singapore, right? So for good reason. So if you were to buy a 4-room non-mature resale flat, you need to spend 500,000, right? And if you were to pay in full in cash, that is 500,000 in cash, and most people don't have that kind of money unless they marry someone who is very rich. Yeah, that's very rare, right? So for most people, they'll try to fund by bank loans or HDB loan, and even with loans, you still have to fund a portion of your house using cash or CPF. So as you can see, for bank loans, you need 25,000 in cash down payment, which is a huge sum of money already, right? And later on, when you need to fund the other portion of it, you need to take another 100,000 in CPF or cash. So it's a very huge, still a very huge commitment from each individual or each couple, right? So using CPF for housing is a very natural thing to do, and some monies that we have never had control of will suddenly become something tangible that we stay in. So I guess that's why people always associate CPF with housing. Yeah, so brings back to the point, untouchable money is now being used to fund a very tangible asset, which is the home that we stay and sleep in. Yeah, so there is always this consideration to upgrade our home, right, in using CPF. But I guess because Singapore now is a very developed country, we are no longer seeing the kind of GDP growth, salary growth that we see in our parents' generation. So it's natural that people are not able to upgrade. Their property prices are also stagnating or growing very slowly, right? Of course, there are pockets of areas in Singapore where property prices are still increasing. But I think the long-term trend that we should expect is that property prices to grow slower compared to the past. So if we want to go and use CPF to invest in property purely from a investing angle rather than for residential purposes, then I think that might not be the best way for retirement adequacy. Yeah, so that's my personal view on it. So maybe some ways to look at how we can use CPF monies in a more layman way, right? So there's three different buckets of CPF monies, right? The ordinary account, which acts like a high yield savings account, the MediSave account, which acts as a medical emergency fund, and also to pay for medical insurance, and also a special account, which is like a locked-in retirement savings plan. So I guess people like to say that a high yield savings account is something like a bond, but I don't quite agree. It's not really like a bond because you don't get bond-like returns, and the amount is fixed. So, and there's also a lot of flexibility around using CPF OA monies for other purposes, like again housing, insurance, investment, and education. So I would treat it like more like a high yield savings account. And I think Xin can elaborate more on what you can do with CPF monies.
So we all know that we can't withdraw our CPF until we're 55. So what else can we do in the meantime with your CPF? Well, as Sheng-Shi mentioned, there's housing. But just note that, with housing, there's a trade-off, because when you sell your house and you return, the amount to CPF, you also have to pay the accrued interest. Okay, the second thing is insurance. You can pay for your insurance premiums on your dependents protection scheme and home protection scheme. You can spend it on education, for tertiary education for yourself, for your family. And I want to elaborate a little bit more on the fourth and the fifth options, because we're really talking about maximizing and growing your CPF in this session. So you can transfer your OA funds to your SA and get a higher guaranteed interest rate. The thing is that these transfers are irreversible. So if you think that you may need the funds for housing or education, for example, then that's probably, not a great idea. And I see that we have a question now actually in our chat just on this very topic. Is it better to transfer to my SA or invest my OA?
Yeah.
So I think this question is right up Sheng-Shi's alley.
Yeah.
He's written extensively on it.
Yeah, Andrew, thanks for your question. So it really depends on your life stage and your risk appetite, right? So I guess the way I see it is as like CPF SA money is really like a locked-in retirement savings plan. I would even equate it to like buying a savings plan or endowment plan with a financial advisor. So you have definitely this is you're getting much better returns than a endowment plan from a financial advisor, right? So you get around 4% or the 10-year Singapore government bond rates plus 1%, right? So that is the benchmark rate, or 4%. So currently we're getting 4%, which is awesome, right? But the money is locked in, so it's not really like an investment. So it's really like a forced savings plan, right? When you make that transfer, you're subscribing to a forced saving plan. Whereas when you're investing it, you always have the option to liquidate your investment, to use it for other purposes. But of course, it is not, because the way CPF is structured and the agent bank charges involved, it's not very easy to invest in a more active way for CPF monies. So I think back to your question, both ways can work. It really depends on your personal risk appetite. If you have a tendency to trade in and out, and you have a tendency to be very emotional with your investing, then I would say that going with the savings plan is a good way. But if you want to invest, you have been seasoned with investing, you're comfortable with investing for the long term, it's actually better to invest your CPF OA's monies, because there's a long runway involved. Because it's not really your money yet, you don't actually feel it. So the behavioral aspects of it is that you can remain invested. So it really depends on your own risk appetite as well as what you're looking for.
So Sheng-Shi, how much can you actually transfer into your SA?
Okay, it's you can only transfer up to your full retirement sum, which for this year it is up to $181,000. So I think there's a lot of people who already hit the full retirement sum, and they will be looking at investing at that point of time, be it through a home, through another second property, or to invest their CPF OA money. So I think having that, for most of those people, they are already pretty advanced, right? They would want to, I'm sure they look out for the different options. So maybe later on when we are sharing about the different investing options, we can elaborate more on that.
Okay.
Yeah.
So we actually have, on a graph just about this. about the differences in your OA balances over time. So assuming that, same assumption, starting salary $3,000, 4% annual increments, 2 months bonus, you'll contribute $470,000 in your OA over 30 years. So if you do nothing, you leave it in your OA account, you get the 2.5% returns with no risk, you'll have $700,000 at the age of 55. If you max out your SA, transfer it there, you'll get $800,000 and also with no risk. But if you invest into the markets with risk, obviously, you could potentially get 1.3 million at the age of 55. And obviously it won't be this, smooth chart that you see on the slide. You'll have time periods like this past month where your portfolio is down 20%. But just remember that you're investing over 30 years. And what you really care about is the long-term expected returns.
Yeah, maybe let me just elaborate on that point, because I have invested my CPF OA monies with Endowus, and because of the way the markets have moved, and I've invested more at this, I've invested most of my money at the start of the year. So obviously the markets did very badly, and I lost like around 30% of my CPF OA monies invested through Endowus. So the volatility is real, right? But from our angle, what we actually see is it really doesn't, we don't really feel that volatility because the money is locked up anyway, right? So for me, I'm actually looking at the amount here rather than the volatility along the way. So that's how I condition myself and how I feel better about staying invested, right? Looking at a longer perspective, and knowing that I'm invested in a diversified low cost way, so I have a better chance of hitting this number. Yeah.
So I just wanted to show a chart here, what the markets have done versus the CPF OA return of 2.5%. So say you had invested $50,000 in the MSCI All Country World Index in 1990. So 30 years later, you would have had a return of 392%, versus if you left it in your OA, where you would have had a cumulative return of 130%. But, again, like what Shang-Chi was talking about the volatility, look at here doing, the tech boom and bust, and then here during the great financial crisis, you can see that, your portfolio definitely has far higher volatility than the 2.5%. And there are some years where, like during the financial crisis, your portfolio would have been down like 30-40%. So that's something to, take into account as well when you decide on what type of allocation you want to be in if you decide to invest. Because the most important thing is that, you can stay invested for the long term and be invested in the portfolio that's appropriate for your risk tolerance. So there's another interesting chart here that I wanted to share with you guys. So just look at the red box on the right. So this is basically the performance of a balanced portfolio, which we have designed as 60% invested in stocks in the MSCI All Country World Index and 40% in bonds. So if you see that over a 1-year period, this balanced portfolio has historically, since 1990, only outperformed the CPF OA rate of 2.5%, 70% of the time. I mean, it's okay, but I want better odds for my own portfolio. But if you extend the time period longer to 3 years, 5 years, or 10 years, you can see that your probability of success is much, much higher. Over a 15-year period, you have a 100% historical chance of outperforming the CPF index. So it's really about, time in the markets.
So Cindy, maybe let me just ask you, the MSCI World Index as well as the bond index, is that the way that Endowus choose to structure its portfolio?
The way that Endowus has structured portfolios is that, we really want to create a globally diversified portfolio. So we're invested in both like developed market equities, emerging market equities, as well as global bonds.
Okay, got it.
So hopefully we have convinced you by now that, you would consider investing your CPF. So next question is, what can you actually invest in? So you have to set aside the first $20,000 in your CPF OA, and the rest of it you can invest. So this is called your investable savings. You can invest 100% of that in unit trusts, in government bonds, in ETFs, and investment-linked products. You can invest up to 35% of these savings in Singapore-listed equities, and 10% of the savings in gold ETFs. And just focusing on the equities investing options a little bit, because it's something that I know a lot of people are interested in. So we first look at, Singapore listed stocks and ETF. So even the list of SGX stocks is limited.
Very limited.
Yeah, and actually, fun fact, High Flux was on this list at some point. So you could have actually used your CPF to invest in High Flux.
Yeah, it's not a very good result, as I can imagine. Yeah.
Oh, sorry. And the problem with investing in, Singapore stocks and ETFs is that we're all so exposed to Singapore already. I mean, we live here, our jobs are here. If we own property, it's here as well. And so what we really want to do when we invest is to invest in something that's more globally diversified. So another option is unit trusts, which you can invest 100% of your investable savings in. The problem with unit trusts in the past is that the fees were so high. So if you went to like a DBS or OCBC or any of the traditional brokers, if you wanted to invest, your CPF in unit trust, they would charge you a upfront sales charge. This will be hopefully dropped to 0 this year, but right now they can still charge you up to 1.5%. They can also charge you a wrap fee of 70 basis points, which will drop to 40 basis points at the end of the year. And the other recurring fee that we have here is the expense ratios of the funds. And so, that's something that we've tried to change at Endowus. We've really tried to, cut down cost at every level, so that we can improve your probability of success. So we have no upfront sales charge, as you can see here. And the recurring fee here of 1% includes both, the access fee that we charge of 40 basis points, as well as the net expense ratio of the funds. So let me just show you the difference in cost. And for those of you who have listened to our past webinars or presentations, that we always harp on cost. Because lowering your cost is the easiest way of improving your returns. So traditionally, assuming a 60-40 balanced portfolio, the industry all-in cost is close to 3.5%. So right out of the door, you're already down 3.5%. And in Endowus, we've lowered this to slightly under 1%. And we want to commit to continuing lowering our fees when we gain more scale.
Yep. So I think we brought in the first passive fund into the CPFIS. So maybe, Xin-Ting, you want to elaborate more on that?
Sure. So previously, we thought it was not great that there were no passive low-cost products on CPF. So we worked really, really hard with CPF as well as Vanguard and Lion Global to bring the first S&P 500 index fund onto CPF. And actually, we are the only players that can distribute this fund at the moment. And the reason behind that is that because we rebate any trailer fees that we receive from the fund manager back to you, which means that the net expense ratio that you pay will fulfill CPF's criteria, their cap for fees for passive funds. And we want to continue bringing more products that we like and that we think is good for the CPF members to plan for retirement. So I thought this was a really interesting chart. When you talk about investing, sorry about that. When you start really makes a big difference. So if you look at this chart, Tom, Dick, and Harry. So Harry, he plans his finances very well. He started investing $10,000 a year for 10 years at the age of 25. So in total, he invested $100,000. Dick, on the other hand, he started investing $10,000 a year only at the age of 35. In total, he invested $200,000. Tom's a bit of a late bloomer. He only started investing at the age of 45. He actually, in total put in the most capital. He invested $300,000. But as you can see at 65, Harry here has 1.4 million, Dick here has 1 million, and Tom here has 750,000, which really proves that, starting early and having more time in the market is one of your biggest assets. So Shang-Chi now is going to talk a little bit about, the different strategies of maximizing your CPF at different stages of your life.
Yeah. Okay. So so I'm going to cover 3 different stages of your life, right? When you're young, when you are in your mid-career, and when you are cruising in life. So for the young people, including me, aged between 24 to 27, you want to start that most difficult part, which is to talk about money with your plans, with your spouse, or someone that you are planning to settle down with, right? So what can be less romantic about than talking about how splitting costs? So I guess
the biggest cause of fights between couples, I think.
yeah, it's the biggest cause of fight, and I think the really awkward thing is that you're not just going to ask them like, hey, do you want to BTO? You're going to ask them things like, how do you want to split the BTO cost, right? So how do you want to split the monthly mortgage payment? So having that conversation in place is very, very awkward. I have friends who are, really going to settle down, going to get the proposal ring and everything, but they have no idea how to split costs with their girlfriends or boyfriends. So so this is a very big to-do, right? Have a way to have that awkward conversation with your spouse, your boyfriend or your girlfriend, right? I think that's the biggest takeaway. Other things like paying off your siblings' tertiary education with CPF, investing your CPF, doing the OA to SA transfer, I would say it's less important. Maybe at a younger stage, it's more important to focus on the housing and to have that flexibility with your CPF OA money. But I guess having a broad plan and discussing that broad plan with your spouse, your partner to be, is more important because it sets the direction and the tone of how you use CPF. Okay, on the next one, in mid-career, you'll probably be like a sandwich generation, right? Because you have to plan for your own children, you have to plan for your own expenses and finances as well, and you have to plan for your parents' retirement, right? Your parents' retirement and their retirement adequacy is a very big concern for you, right? So between the age of 28 to 40s, considering doing an OA to SA transfer for your parents' SA or RA account is very important, right? Because you'll be able to fund their retirement better. For the government, I think they are also trying to match top-ups for that in the recent budget. So considering that option and trying to maximize it from a family perspective, I think it's very important, right? Because you are not only just securing your own CPF monies, you are securing your family's retirement adequacy.
Is there a cap on that for how much you can transfer to your parents?
There's to get that $700 match. Yeah, it's $700, right? Okay. But I don't think there's any tax relief from that. There's no. I don't think there's a cap to that. Yeah. So for housing, of course, times are hard, right? So building up your OA for a mortgage emergency fund is extremely helpful. I guess for people, especially with all the market volatility, you don't want to be out of a job and you have a mortgage to serve. So building up a CPF OA balance is helpful in case you know something happened and you have to be out of job. So then the last few things on the priority list is to invest your CPF. Consider investing your CPF money, right? And then of course to pay for your siblings' education if it's relevant.
I mean, would you recommend someone invest, a lump sum or do recurring investments for their CPF?
I think it really depends, right? So you have to look at a longer term plan because
Yeah.
there's always recurring money into your CPF
Yeah,
OA.
exactly.
Yeah, so I guess for me, I tend to invest a bit more like a lump sum, right? Because I know that moving forth, I will have like $900, $1,000, and even when I get my bonus, right? That bonus amount will also be CPF contribution,
Yeah.
right? So just investing it in a very consistent way, I'll be forced to invest in a very consistent way. So I think it's definitely fine to invest a bigger sum at the start, maybe spread it out across 3 months, 6 months. Then later on, you can invest the remaining amount on the monthly on a regular savings plan basis.
Yeah, I mean, I think the regular savings plan also takes, the market timing aspect out of it because you invest in a very disciplined manner on a monthly basis. So for those of you who don't want to time the markets, you just want to set it and forget it. That's a great way to invest as well.
Mm. Yeah. Okay, so for great point, investing consistently in a non-emotional way. Anyway, the money is locked up until 55, right? So I guess it's we can try to be very very strategic, very methodical in our investments when it comes to CPF. So for the older people, for the cruisers, right, between the mid 30s to 50s, it really
Older.
I guess. I guess I would associate the cruisers to people who are already more or less settled with the big financial decisions, right? So you could be someone who is single and you're not gonna buy a house anytime soon. So I'm by definition a cruiser to some extent, right? Yeah. So as long as you have your big big financial decisions out of the way, I guess you can be defined as a cruiser, right? You can look more at maximizing your CPF rather than considering your mid-term or short-term financial decisions. So from that perspective, looking more towards a savings plan or investing is important, right? If you haven't hit your full retirement sum, I think now at this stage you will more likely want to do that OA to SA transfer, right? If not, you want to invest your CPF because the at full retirement sum is not just looking at your special account, it's looking at both the OA and your SA. So growing your OA pool is also very important. Yeah. So then of course, if you're at a later stage of your life, you want to free up more cash for other purposes and you want to pay for your kids' tertiary education using other means, then growing your CPF OA money and paying for your kids' education with CPF is very helpful as well. And of course, if you are so set in life and you want to be debt free, you can pay off your housing with CPF monies. Yeah. Okay, so I guess it goes back to Endowus' goal, right? To help people invest better, to live easier today, and live better tomorrow. So I guess one thing that we talk quite frequently about is the regular savings plan. So it's possible for people to invest their money, CPF, SRS, and cash, one shot on our platform, and you can just spend like 5-10 minutes setting your goals and set a recurring investment through Endowus, so that you are invested in a very globally diversified way at a low cost, so that you focus on the other things in life.
Yeah. If you guys have any questions now, it'd be great if you could just type this into the live chat on the right side of your screen. And again, let me just flash the QR code if you wanted to enjoy our sign up offer today. So there's a QR code that you can scan on the left. Again, this is for 50% off your access fee for the first year, provided you invest $10,000 of CPF or more.
Okay, I see our first question. I'm 40 years old and late to the game. How should I plan using Endowus platform? Late to the game, I guess, probably mean late to the investing game, I guess.
I think at 40, you're definitely not late to the investing game. I mean, at 55, you can withdraw your money, obviously, but you don't, I mean, the investing does not stop at the age of 55 or even stop at retirement, right? You'll continue to invest through retirement, and depending on what your kind of financial goals are, say if, you want to leave some money for your kids, if you wanted to spend all your money in your lifetime and things like that. So you're definitely, it's definitely not too late to start. At this point, and you should definitely check out our platform. And not, I mean, we offer CPF, but we also offer SRS and cash investing options.
Yep. So we have another question by Lim. Are you going to share what are all the funds we can invest with Endowus using CPF? So shall we go back to the previous slide?
Yeah, we have let me take a look. So these are the fund managers that we have currently partnered with. They're some of the largest fund managers globally, and we use, some of their funds to build our portfolios. So depending on your risk tolerance, we will advise you on which asset allocation to be in. So it ranges from 100% bonds to 100% equities. And then depending on that, it'll be a mix of funds from these various fund managers.
Yep. So Lim, maybe just to share a bit more, we will be having another webinar specific to CPF investing next week. So we'll be more than happy to share more on that webinar itself. Or you can just sign up, go through the Endowus platform through the link, QR code that we have flashed, as well as the link below.
Yep.
So through that link, you'll be able to see the kind of funds you have as you play around our interface. So all of this information is online, but we'll elaborate more next week.
Yeah. Sorry, we're just looking at some of the new questions that are coming in. Could you be slightly more prescriptive? Should I go for your 80-20 rather than the 60-40? Okay, it's a great question. I think it's important to look at your overall allocation because CPF just makes one part of it. So you should look at, what else are you invested in outside, whether that's heavy in equities or bonds, and how your CPF portfolio should complement it. How I like to look at my own CPF portfolio is that I use my SA portion as kind of like the bond allocation because, I'm guaranteed at least 4% return from my SA portion.
Up till end of the year.
Up till end of the year. Shang-Chi is correct. Which it's actually really hard to beat with any of the bond funds out there on a consistent basis. So that's my bond allocation, and I actually I use my OA to predominantly invest in equities because I like to look at my allocation as overall, quite holistically, rather than just focus on the OA portion.
Yep. Just that maybe from an investment angle, it's a bit difficult to rebalance, right? Since CPF SA money is stuck there, so you can't really rebalance it to sell some of your SA to buy equities. So there's some restrictions on that end. So I guess it's really like bond, but it's with the with the commas.
Yeah. Okay, so we have a follow-up question on our CPF funds. So the question is, I'm wondering if the detailed fund listing is available on your website. Yes, it is. If you go into our FAQs and look up what investment funds we have in our portfolio now, you'll be able to see the list. And also if you created an account, and even if you don't want to invest right away, you can kind of play around with the different allocations and see which exact funds are in which of the portfolios.
Yep. So I think there's a few more questions. Are the funds invested dependent on whether you use cash, CPF or SRS? So the answer is yes, right? Especially for CPF because as a player within the CPF field, we only have access to the CPF IS investable universe, right? So we have limited funds to play with, in short. So we try to construct the best, most diversified, low-cost portfolio for you, right? And we are working hard to bring in new funds so that the cost of investing is lower, you have a more diversified portfolio, and you have a greater chance of getting a market return. So I think what Endowus is trying to do is trying to capture market return at the lowest cost possible, based on the fixed asset allocation. So yes, definitely we are constrained with the CPF IS investable universe, but we'll do our best as advisors to bring in better products for our clients.
So we talked about it briefly before, but we had worked with Lion Global and Vanguard to bring the first passive fund onto CPF, the S&P 500 Index Fund, and we're looking to onboard more funds in the very near future as well. And just another note, so our cash and SRS portfolios are currently, we have the same allocation. So we use dimensional as well as PIMCO products for that. And for CPF, it's a different set of funds.
Yep. Yeah, so I guess the funds on cash and SRS are exclusive funds for us, right? So we use the institutional share class. So it's actually very different from the banks or the financial advisors or even online platforms that the type of unit trust that they use. So the kind of expense ratio that we are looking at is around 50 plus 0.5%, or for equities is 0.43%. So I think unit trusts have a bad name because of retail investors' experience with the high cost retail share class, which is up to 1 plus 2%, right? And I think people, ETF is the cool thing now, right? And a lot of people, including myself, we have invested in ETFs. So I guess there's an aversion to unit trust, but I think the kind of unit trust that we're using, which is exclusive, Sing dollar denominated or Sing dollar hedge for bonds. So these are, I would say they are more suited for retirement planning, especially for the bonds part where you have your currency exposure hedged.
Let's look at some of the other questions that we're getting. Let's see.
Yeah, guys, if you don't mind, can you just go on to the feedback form? I hope we get some feedback on how we are doing, as well as some of the topics that you are interested in, so that we can produce content that is relevant and interesting to you.
Yeah. Okay, so we have a question here from Andrew. I have invested my CPF but have lost money on my investments. Should I cut my losses? That's a great question, Andrew. Thank you. It's a painful time for my own portfolio since the beginning of the year.
For our portfolio.
For our portfolios, right?
Yeah.
It's inevitable when the market has such sharp declines that your portfolio is going to go down, with it as well. But the thing is, you have to remember that you're investing your CPF over the long term, and these short-term market movements. You shouldn't. It's hard. But you should try and not react to them. If you look at the S&P 500 index, for example, since 1928, it's has annualized returns of about 9%, and this is through wars, through crises, through recessions. So it's just important to keep in mind that what you really want exposed to is a long-term market returns, which are positively skewed if you look over like a 20-30 year time period.
Yeah. So I think for every time when you go through a crisis, it always feels like the world is going to end. I think they call it recency bias when it comes from a behavioral finance angle, right? Yeah. So it always feels that, this is extremely bad. This is the worst thing that has ever happened. Financial markets are going to collapse and things are going to be terrible. But the thing is that, like what Sinting has shared, like we have gone through wars, we have gone through SARS, we have gone through Asia financial crisis, and every time the market will pick up, right? So I think the way to look at it is to look longer term, right, and not to be so caught up with the recency bias.
Yeah, none of us know, what's going to happen over the next week or month. Like, we don't know when this COVID virus will get better or when the markets will bottom and rebound. But what we do know is that, kind of 10, 20, 30 years from here, we will see, higher levels than we do now.
Yeah, so it's also another thing. I guess there are people who have been asking us, like, should I buy SIA? Should I buy DBS? So the point that we want to bring across is that it's a lot easier to stay invested when you are investing in a very globally diversified portfolio, right? Maybe Apple will not be well next year, but you have Google exposure, you have Microsoft, you have tech companies, you have banks, you have all sorts of different exposure. So that is the kind of portfolio we want to create for our customers, right? Very diversified portfolios that they feel confident that over 20-30 years you will do well. So it's not making sectorial bets, it's not overweighing certain sectors, not underweighing certain countries. Really diversified, boring way of investing that help people stay invested, right? So I think someone said that investing should be like walking, waiting for the paint to dry. So that's the type of portfolio that we want to create. Preferably you invest through Endowus and you not touch your account for a month or for a year, and things will just automatically work on its own. Yeah.
We have another question here. Isn't this the perfect time to pile on if you're looking 10-20 years ahead? Well, I don't know if there's a perfect time. You'll probably never buy at the market bottom. But I mean, I've personally put, a little bit more money to work over the last couple of weeks, and I want to put more money into the markets if we see, even greater declines. I mean, for me, I think, at this point of time, human capital is still my largest asset. I'm going to still see, more income. I'm going to still be investing more. And, for the long term, being able to invest at these lower levels is actually beneficial for me.
Yeah. Okay, I think maybe you just take one more question, then we'll call this session to an end.
Sure.
Yeah. So I think Zaz has asked another question. How should I split my CPF versus cash though? So I think it's probably referring to how to invest, how to split the investment. I think in short, you just invest whatever you are comfortable with. So the most important, I mean, from our perspective, is that you should invest in a way that invest for long term. So if you, as long as you don't have any need for the cash or the CPF monies, do consider being invested at a risk level that you're comfortable with, so that over a longer period of time you have a good chance of succeeding. So being in, I think the question back to you will be, what's your time horizon and what's your risk appetite? Then with those two questions answered, you'll be able to invest those monies. Yep. Okay. Well,
thank you guys so much for listening to our webinar today. Again, we have a sign-up offer if you open your account today. And also we have a feedback form on the right, and it would be great if you could give us some feedback on, things we can do better, what type of topics you'd be interested in listening to, and just any other feedback as well.
Okay. Thank you, everyone.
Okay, thank you.
Have a good evening. Bye-bye.
Bye.